You did everything right. Good job, 2 degrees. But homeownership feels like a fantasy. Here's a number that explains why. A recent CoreLogic analysis found nearly a quarter of all single-family homes sold in America went to large-scale investors, not families. And according to the Federal Reserve, the income you need to afford a home has shot up 50% since 2020, while wages only grew 26%. This isn't a feeling. It's math, and this video gives you the data-backed playbook to fight back. Let's start with part 1, diagnosing the problem with real numbers. The feeling that you're falling behind, that the goalposts keep moving, isn't in your head. It's a documented economic shift. For generations, the golden rule of affordability was simple. Your housing costs shouldn't exceed about 30% of your gross income. This was the benchmark that allowed families to buy a home, save for retirement, invest, and build a stable life. Today, that benchmark is a historical artifact. According to a recent analysis by Tufts University using Federal Reserve data, the annual cost of owning a median-priced home now consumes a staggering 47% of the median household income. Let that sink in. Nearly half of every dollar earned by the typical American household is required just to own a typical American home. This isn't a slight increase. It's a fundamental breakdown of the financial model that built the middle class. When housing costs this much, it fundamentally changes its nature. It ceases to be a stable asset that builds your wealth and instead becomes a high-cost service you're subscribed to. This is what I call the subscription trap. You're no longer building equity in a meaningful way. You're just servicing an incredibly expensive subscription that drains your ability to build. Every dollar over that traditional 30% threshold is a dollar that isn't going toward your retirement, your investments, an emergency fund, or your kid's education. It's a constant draining pressure that leaves no room for error and no path for advancement. Let's make this real. Take our example, Alex. Alex is 30 years old, a talented graphic designer earning $75,000 a year. By all traditional measures, he's successful. His gross monthly income is $6,250. Right now, he rents a one-bedroom apartment for $2,200 a month, which is already 35% of his gross pay, pushing the limits of affordability. He's been diligently saving, trying to get a down payment for a $450,000 condo in his city. But when he runs the numbers, the reality is brutal. A mortgage on that condo, once you factor in property taxes, homeowner's insurance, and potential HOA fees, would be close to $3,000 a month. That is 48% of his gross income, perfectly aligning with that national data point from Tufts and the Fed. At that level, Alex wouldn't just be house poor, he'd be financially paralyzed. His ability to save anything would evaporate. Investing for the future would be off the table. Any unexpected expense, a car repair, a medical bill, would become a full-blown crisis. And he feels like a complete failure. He looks at his parents who bought their first house when they were 28. His dad was an electrician, his mom a part-time secretary. Their combined income, adjusted for inflation, was less than what he makes now, yet they managed it. What Alex doesn't realize is that he isn't failing. The game has been changed on him. He's trying to win a 2024 game playing by 1980s rules. The solution for Alex begins with a critical mindset shift, acknowledging that his reality is the 47% statistic. He needs to stop framing the problem as "I can't save enough" and start framing it as "the financial model of homeownership is broken for my generation." He has to stop comparing his situation to his parents because the economic variables, interest rates, home prices relative to income, and institutional competition have fundamentally and irrevocably changed. When he does this, something powerful happens. The anxiety and self-blame are replaced with a clear-eyed view of the real problem. He's not losing the game. He's been invited to a rigged one. This financial pressure does something profound to our collective mindset. In about 60 seconds, I'll show you a Federal Reserve chart that proves the American dream is statistically dying. This isn't just about individual budgets like Alex's. It's about a nationwide psychological retreat from a core tenet of American life. For decades, the aspiration to own a home was nearly universal. It was seen as a rite of passage, the ultimate symbol of stability and success. But when the math no longer works for millions of people, the aspiration itself begins to crumble. And this isn't just a feeling in your gut. The Federal Reserve Bank of St. Louis confirms it with hard data. Their surveys track renter expectations, asking a simple question: do you expect to own a home one day? In 2019, before the massive run-up in housing costs, 52.6% of renters, more than half, said yes. They believed that eventually they would get there. Today, that number has collapsed to just 33.9%. Unless this is the statistical evidence of a dying dream. It's a collective, rational response to an irrational market. People are not giving up because they're lazy. They are giving up because they have access to mortgage calculators and can see, just like Alex did, that the numbers are impossible. They are now for part 2. The architects. Who is the they that's making housing so expensive? In conversations about this topic, you often hear a vague they. They are buying up all the houses. They are pricing us out. It's time to replace the anonymous they with facts. The antagonist in the story has a name: institutional investors and private equity funds. In the hook, I mentioned a core logic analysis. Let's dig into that. They found that in 2021, a peak year in this trend, institutional investors bought nearly 1 out of every 4 single-family homes on the market. Let me repeat that. Nearly a quarter of the inventory of starter homes, the very homes that generations of families used to build wealth, were snapped up not by people, but by corporate balance sheets. This isn't a small trend happening in a few select cities. It's a systemic buyout of the American starter home market. To put it in perspective, imagine going to a grocery store and 1 out of every 4 loaves of bread was bought by a single corporation before you even got there, with the intention of selling it back to you later at a higher price. That's what's happening to the housing supply. It's an artificial supply shock created by entities with bottomless pockets. But why did Wall Street suddenly get interested in your cul-de-sac? The answer goes back to the 2008 financial crisis, which created the perfect opportunity for this takeover. In the aftermath of 2008, there was a massive wave of foreclosures. Millions of homes were available for pennies on the dollar. Private equity firms, flush with cash, saw an unprecedented opportunity. They realized they could buy thousands of these distressed single-family homes, renovate them, and turn them into a massive, scalable rental portfolio. They created a brand new asset class, the single-family rental. For them, it was a perfect investment, a tangible asset that produces consistent monthly cash flow. For the average American, it was a disaster. It marked the moment that the single-family home transitioned from a cornerstone of community to just another line item on a hedge fund's quarterly report. This is the unfair advantage that individuals are now forced to compete against. You, with your carefully saved down payment and your pre-approval letter from a bank, are bidding against an algorithm. You are in a bidding war with a multi-billion-dollar fund that makes an all-cash offer, waives all contingencies, and can close in 7 days. It's a game you are structurally, mathematically, and financially designed to lose. They don't get emotionally attached. They don't write letters to the seller. They run a calculation, and if the numbers work for their rental yield model, a legal entity with a generic name makes an offer you simply cannot beat. This is what your competition looks like. Not a family, but a legal document designed for one purpose: acquiring assets. Let's return to Alex. After weeks of searching, he finally found that $450,000 condo. It was perfect. He put in a strong offer at the asking price, proud of his financial position. A few days later, he gets the call from his realtor. His offer was rejected. The winning bid was for $470,000, all cash, from a buyer named 123 Main Street Holdings, LLC. Alex is crushed. It's not just that he lost the condo, it's the way he lost. How can he possibly compete with an all-cash offer that's $20,000 over asking? He can't. 123 Main Street Holdings, LLC doesn't need a mortgage. It doesn't need an appraisal. It's a nameless, faceless entity that swooped in and took his dream off the market. But this is where the story pivots. By connecting his personal rejection to the core logic statistic that a quarter of homes are going to investors like this, Alex has a profound realization. He wasn't outbid by another person, he was outcapitalized by a system. His frustration begins to fade, replaced by a cold, strategic clarity. Trying to win a bidding war against a Wall Street fund is not a sign of ambition. It's irrational. It's like stepping into a boxing ring with a heavyweight champion. You don't win by trying to punch harder. You win by leaving the ring and choosing to play a different game entirely. Alex is no longer frustrated. He's now a strategist, ready to find that different game. I want to hear from you in the comments. Does that 47% housing cost feel real to you? And have you ever lost a bid to an all-cash offer? Share your experience below. Reading these stories shows how widespread this issue really is. We've defined the problem and the players. Now for part 3, the counter machine. Here is your specific 3-step action plan. This isn't about saving an extra $100 a month or cutting out lattes. This is about building your own financial engine that is more powerful and more efficient than the broken model of home ownership. Step 1 is to out-earn traditional savings by moving your cash to where it's treated best. You need to build an opportunity fund, and the place to do it is a high-yield savings account, or HSA. For decades, people have left their savings in accounts at big traditional banks, earning next to nothing. The first step is to make your cash work for you. According to Bankrate, while the average savings account in America pays less than 0.5% in interest, many online high-yield savings accounts are offering up to 5% APY. That is not a typo. That's more than 10 times the return for the same money, with the same FDIC insurance and security. Let's look at Alex. He has $20,000 saved for his down payment, sitting in a regular savings account earning about 0.4% interest. Per year, that gets him a whopping $80. It's not even keeping up with inflation. His money is actively losing purchasing power. By taking 15 minutes to open an HSA online and transferring that money, his return changes dramatically. On that same $20,000, a 5% HSA gets him $1,000 a year in interest. It's the simplest and biggest financial upgrade you can make this week. This account becomes your foundation, your opportunity fund. It's liquid, it's safe, and it's actually growing, ready for you to deploy when a real opportunity arises, not just when a house you can't afford hits the market. But isn't the stock market risky? I'm about to explain why owning one single house in one single zip code is mathematically far riskier than owning a tiny slice of 500 diversified world-class companies. This brings us to step 2. If you can't beat the machine, own a piece of it. Instead of pouring all your capital into one single illiquid asset, a house, you can own a piece of 500 of the most profitable companies in the world through a low-cost S&P 500 index fund. These are companies you interact with every day. Apple, Microsoft, Amazon, Google. The same massive corporations whose success drives the economy are the ones you can invest in. This isn't about picking stocks or trying to time the market. It's about buying the entire market in one simple, diversified investment. Based on historical data compiled by Carry.com, from 2014 to 2024, the average annual return of the S&P 500 has been 11.01%. Compare that to the housing market, which is prone to local bubbles, high transaction costs, maintenance expenses, and illiquidity. With an index fund, you have a globally diversified liquid asset that has historically proven to be one of the most powerful wealth creation engines in history. This is how you outpace the housing market. While your money in a house is locked up, subject to the whims of a single neighborhood's property values, your money in the market is spread across every sector of the global economy, working for you 24/7. This leads directly to the most important part of the strategy. Step 3, change the scoreboard. For generations, the primary financial goal for young adults was down payment saved. We need to throw that scoreboard away. It's an outdated metric from a different economic era. Your new primary goal, your new scoreboard, is net worth growth. This shift is everything. It moves you from a defensive position, saving up to afford a massive liability, to an offensive one, building a flexible, powerful portfolio of assets. Alex embraces this. He takes his $20,000 and moves it to that 5% HSA. Then he sets up an automatic investment of $500 every single month into a low-cost S&P 500 index fund, something like VOO. And he starts tracking his total net worth, his cash plus his investments, on a simple spreadsheet. He's no longer obsessed with hitting a magical down payment number for a condo he can't afford. He's focused on making the total value of his assets go up every month. Let's fast forward 1 year. His initial $20,000 in the HSA has become $21,000 thanks to the interest. His $500 monthly investment, $6,000 of his own money, assuming the historical 11% average return, would be worth over $6,600. His total net worth, not even counting his ongoing contributions, has grown by over $1,600 from passive returns alone. In total, his assets have grown by over $7,600. For the first time, he feels like he's on offense. He's building wealth on his own terms. He sees a clear path to financial freedom that doesn't depend on going into massive debt for a single property. He is in control. Which of these 3 steps are you going to start this week? Comment 1, 2, or 3 below. Let's bring this all together. The feeling of being trapped in the modern housing market is not a personal failure. It's a calculated reality you've been forced into. The key takeaway is this: housing unaffordability isn't your fault. It's a mathematical reality defined by the cost of ownership rising twice as fast as wages, a fact confirmed by the Federal Reserve. You are not behind. The finish line was moved. The second takeaway is that the game was intentionally changed by institutional investors. As the CoreLogic data shows, they now buy nearly a quarter of the available single-family homes, creating an artificial scarcity and making direct competition unwinnable for the average person. But the most important takeaway is the third. You win by refusing to play their rigged game. You win by playing a different, better one. Your new goal is not homeownership at any cost. It's net worth growth. You achieve this with proven, accessible tools like high-yield savings accounts and S&P 500 index funds, which historically have provided returns that allow you to build wealth faster and more flexibly than being locked into an overpriced mortgage. So here is your playbook. The immediate action you can take today is to research and open a high-yield savings account. It takes less than 20 minutes online. Move your emergency fund and your short-term savings there immediately and start earning 10 times more interest. Your short-term action for this month is to open a brokerage account and research low-cost S&P 500 ETFs like VOO, IVV, or SPY. You don't have to be an expert. Just set up a small recurring automatic investment, even if it's just $50 a month to get started. And your long-term ongoing mission is to change your primary metric of success. Stop tracking down payment saved. Start tracking your monthly net worth growth. Use an app or a simple spreadsheet. Watch it grow. This is your new game, and these are the new rules. Celebrate your progress because you are building true financial freedom. If this video gave you a new perspective, hit the like button and share it with one friend who feels stuck in the rent trap. And subscribe for more data-backed strategies to navigate the new economy. We cut through the noise with numbers. This video is for educational purposes only and is not financial advice. All investment decisions should be made with the help of a qualified professional. All data is from reputable sources like the Federal Reserve, CoreLogic, and Bankrate as of December 2024. Products mentioned are examples, not recommendations. Past performance is not indicative of future results. Please research and consult a licensed financial advisor for your specific situation.